What change do you think have the greatest market impact in local equity market performance in 2017? Is it A, US President Donald J. Trump, B, our President Rodrigo R. Duterte, C, fund flows, D, economic growth, E, rising interest rates, or F, the US dollar? And key in your answers, guys. I think we have 30 seconds to do that. What factor will affect our market performance this year? Yeah, automatic lang. If you want to change your answers, just key in the new answer and then I think you can click OK or just leave it be. Time is up. The results are, wow, 26.6% says economic growth. But you see here, Joel, you see that around 15% are concerned about the US president, about 17% concerned about the fund flows, and around 6% concerned about US dollars. Can you comment on these concerns?
I agree with the audience's majority that something Buffett said, which is in the short term, the market is a voting machine. And so things like fund flows and beliefs over what a president of any country might do can drive the stock market up and down wildly. But over the longer term, at the end of the day, in the long term, the market is a weighing machine. And what they're weighing is the cash flows of the companies that generate the market performance. And so I think far and well, I would agree with the audience that economic growth is the main driver for the Philippines and frankly for really any market.
Mm-hmm. That's right. Because at the end of the day, whatever happens in the US or whatever happens here, it will have to have some impact in economic growth as well. So I guess what's bothering me personally, Joel, is the fact that, of course, we saw the new president of the United States. And of course, in my early economics lessons, I have understood that part of the reason why other countries are successful is because they have an open trade policy. And for the longest time, the Philippines is a victim of this. We've seen protectionism in the Philippines, and it doesn't take too much to see that our cotton industry, textile before, has all perished because of the lack of competition. So, and you see the former president actually renegotiating the TPP, the NAFTA, trading agreements, and I'm just concerned about the possible economic infantilism that might occur in the US over the long run. What are your thoughts about this?
I'm in agreement. I think closed-door trade policies are a problem. But the issue, I think, is not Trump. I think Trump, he's been very vocal, but just in the last month or so, the EU has been increasing tariffs on steel dumping that they've accused coming from China. You find country to country this kind of thing happening. So I wouldn't attribute that to Trump so much as a serious issue we'd have to consider globally, that the more we have these trade walls, I think the more we have to worry about worldwide economic growth issues. Interest rate environment, I think, sets a stage for what's going on globally. And this is the US Fed rate. One of the things, I mean, a lot of people have been talking about the Fed rate going up, but just to show where it's been over the last several decades, it's got a long way to go. So this idea of the Fed fund rates or the Fed rates starting to rise, yes, they're starting to rise, but from such low bottoms. I mean, really, right now it's gone from 0 to almost 0. That's not a big rate increase. In fact, I think we've got 2 or 3 or 4 years of rate increases to look at. And so when we think about that, relative to the EU and the Euro being, the ECB being at a 0% interest rate, that the Bank of Japan is at a 0 rate, that you've got Sweden and Switzerland at negative rates relative to where the US is headed, I think it says a lot about the environment that we have to think about both for equities and for bonds. The US Treasury 5-year is still under 2%, which I think is awfully low. What that means is there is massive, massive demand for credit. Even high yield debt is trading at just 250 basis points, and so above risk-free. Meaning even companies that are very risky, when they say we're going to issue debt, it seems like the entire world wants it. Well, that is really another way of thinking about sideline cash, because what it says is that around the world, there's just a lot of money pent up, waiting to be invested in the equity markets because nobody's making money when you're investing at 0% or a 0.5% interest rate relative to inflation. All right, so I think this sideline cash is a big positive for equities globally. That said, when we look at all this, the strong dollar is going to get stronger. I think that's something we're going to have to face, and it's not just for the next few quarters. I think we're talking about a 2 to 4 year move of the dollar just getting stronger relative to the other dollars. And the second, that we're going to see that low rates can stay low for a much longer period of time than anyone expects. I think we'll be surprised by that. I know there's been talk about the Fed raising rates, but I think it'll take time. U.S. equities have done this. This is the stock market over the last decade in the U.S., and it's been hitting these peaks. What's interesting is from peak to peak, for the SPY, the S&P 500, from 160 to 240, you'd say, well, that's almost exactly 50% upside. And we say, is that peak to peak? Now, is that high? Well, this is cash flow returns. So earnings, quality returns of U.S. companies are off the charts. If you see that 10%, that means companies in the U.S. are generating a higher return than even the best that we saw in the peak of 2000 with the internet bubble. They're better than what we saw in the peak of 2007. These are the healthiest earnings generating companies we've ever measured in corporate America in 60 years. In 60 years, the highest rate. And when you think that this is on a base of companies that have grown 40 to 50% since 2009, and on top of that growth have also gotten these high earnings, it actually says the market is fairly valued. It's not headed for a collapse, despite hearing that, and we think that the market's perfectly well supported. The other thing to think about is the Q4 earnings quarter has been fantastic so far. I mean, we are seeing companies beat on earnings. We're seeing even top-line revenue beating estimates in more than 50% of the cases. And we've got about a third of the S&P 500 that's coming in. We're right in the middle of earnings season now, but it's looking very, very good. And so short term, it's pushing things. And frankly, the market is very well supported at these levels. This is not a market that's about to crash. Just a bit of a more informal comment that people have asked, so what do we do in the States? Buy the dips. We think there's a correction coming. We think on a sentiment basis, the market is a bit overbought. And so we think there'll be a correction. It'll be a fantastic opportunity to get in. It's buy the dips and don't sell the rallies. Because we think after the dip, it has a long way to go up still in the medium term. Short term, it's going to be rocky. Just to mention one more time why we don't think there's going to be a major equity market collapse in the States. Well, I'm going to show the last, so this is not for your clicker, but just of the last 100 years, which of these market collapses, where the market fell 30, 40, even 45%, were driven by a severe credit crisis? 1907, 1929, the Great Depression, the Roosevelt recession in 38, the credit crunch of 1970. This is the equity markets that fell. LATAM, 1982, the S&L crisis in the 80s, the junk bond collapse, the Asia financial crisis, and I think we know the answer. Every major equity market collapse in the last 100 years has been preceded by a credit crisis, a massive credit crisis, which we have nothing. There are no signals in the United States saying that a credit crisis is coming, that it's even in the earliest stages of forming, we're not seeing it. The Senior Loan Officer Opinion Survey says that banks are very, very healthy. Lending is very healthy. The bond markets in the States are extremely healthy. It doesn't matter if we're looking at high yield or investment grade, it's very healthy across the board. Even the private placement debt markets are healthy. This is one of the healthiest credit scenarios we've ever looked at. People are saying, yes, but there's more debt outstanding today than there was 8, 9 years ago. Yes, there is, but it's not due in 2 years. It's not due in 3 years. It's due over the next, in some companies' cases, over the next 10 to 20 years, which makes it very, very safe. And so when we look at valuation and Trump, we are looking at a market that's around 21 times. But if you look at that, yes, that's high relative to the last 7 years, but it's not high when we look at compared to going back 15 years plus. It says the market's fairly valued. It says the market is not overvalued. When we consider Trump's policies, the lower corporate tax rates, that will favor even higher multiples. Repatriating offshore cash and bring all that cash back in at a low tax rate will also favor higher multiples and higher growth. The spending on infrastructure will favor higher growth. If there's any issue, it's the trade issues that you brought up.
That's right.
That with low investor tax rates and low inflation for now, this is not an expensive market in the States. It's fairly valued with a medium-term upside. Now let's talk about China, just very quickly.
Sure.
This is a very different chart. Remember, I was showing U.S.'s earnings returns at 10%, the highest we've measured in 60 years. China is showing 3 or 4%. Best guess 2016 is 4%, which is one of the lowest you can measure in any country in the world. And so you have one of the lowest economic profit levels that we've measured for any major country ever. And at the same time, right, when we look at the Shanghai, right, we see it off these highs. We're actually saying at these levels, even though the market's come down so much in the last year in Shanghai, that we're still looking at an above 30 times earnings multiple. That is not supportable by a corporate China with a 4% return. And so when we look at this, the idea of China growing or shrinking is a big issue. We think that they're going to have to lower rates. That means the RMB is going to have to fall against the dollar, and we're dealing with all these issues in emerging markets. So my final slide is just to say, when we're in Southeast Asia, for any countries in Southeast Asia, we're navigating these different winds. The U.S. I think the USA is actually an economic tailwind, not a headwind. Right? That strong economy, the confidence for sign-led cash will bring cash to all equity markets. It'll give them confidence in everything, not simply just people putting money in U.S. equities.
Right.
I think China, Japan, and the EU are still headwinds for global economies. We still see weak economies. We see weaker currencies getting weaker over time. And I think to the extent that you're dealing with two very different winds that the Southeast Asia countries have to manage, it becomes an issue. And then finally, there's the winds of Trump, which are in some ways very positive and at the same time, some ways very negative. And it'll remain to be seen which they come out. When we look at, and just a little checklist, when we look at each country walking through India and Indonesia and Thailand and Vietnam and the Philippines, the checklist we would use, this country-by-country navigation of these winds, is one, do they have strong banks? And I think one of the things you notice, the Philippines has very strong banks, something that China does not have right now, and it's a big difference between the two. We're looking at GDP growth rates. India has some fantastic growth rates in GDP, as Philippines does and others. Political stability, I think, is a big issue that we have to look at. It's not the same country by country. Indonesia's been having some issues there. Do we see pro-business policies, right? That will be very supportive. And finally, is it an agile, well-educated workforce? And I think when you look at these ideas, it does suggest that the Philippines is in a very, very good state. Finally, regarding the trade issues, you know, the fact that Philippines is much more BPO-oriented than goods-oriented, I think Thailand and Vietnam and some of the other countries that their exports are heavy, durable goods, washing machines and things like that, I think they're in trouble because those are the kinds of things that could get hit with tariffs very quickly. It's quite difficult to put tariffs on a call center, right? And what have you. And so because of it, I think you walk through these things, these are net positive for the Philippines.
So if I understand correctly, Joel, the improvement in the prospects of the U.S. economy is more a tailwind than the headwind.
Absolutely.
I mean that you're not concerned about investors trying to repatriate their money into the U.S., but you're more looking into the positives of improving their risk appetite and therefore putting more money?
Yeah, I think in the short term, there could be certainly some issues where it seems like money is flowing only to the U.S.
Right.
But the amount of sideline cash sitting in zero or negative real rates around the entire world, confidence in the U.S. stock market will bring confidence to individual countries that have such good opportunities. Not everyone in the emerging markets, but certainly the good ones.
Right. Thank you very much. So let's bring the discussion closer to home. But before that, let me just ask you again, ladies and gentlemen, a question. So how does the 2017 prospects of your business or the company you work for compare to last year's? A, is it better? B, is it worse? Or C, is it the same or no change? Asking about your sentiments, the outlook, and the prospects of your business or the company you're currently employed in. It's a very important question, actually, because we think that our clients are a good sample of the markets. So this could very well mean that the entire equity investor base is thinking the same. Okay, do we have the results? Wow, congratulations. 61.8% thinks it's going to be a better day. So yeah, happy Chinese New Year to everyone. I think it's better. So April, interesting response. Do you think this confidence can, extend to our listed companies at least?
Well, actually, it's quite a mixed bag. In some ways, I was quite surprised with the results.
Oh, really?
Yes. Because anyway, I think, when we were discussing this panel, one of the things we talked about is, I think if ever the prospects are not as good as last year, it has to do with the policies of our new president. So I guess the first thing is, if people have any problems with 2017 is because they don't like what President Duterte is going to do. So in the short term, President Duterte is, I think, bad for business. And let me just clarify, okay? So you can see the policies that he would like to implement in the short term. So, for example, the excise taxes on oil, definitely that's going to have some negative impact potentially on oil companies and even airlines. I mean, it's quite a big increase in the oil prices if say, they add 6 peso per liter for gasoline. Right. And even our travel demands might have some impact. No?
At least there will be less traffic if you increase the price of fuel.
So, and then of course, we also have excise taxes on tobacco and alcohol. So that's also going to be implemented. So, of course, if you own a cigarette company or an alcohol company, that's bad for you. So we have companies like Emperador, Luciatan Group, LTG to be affected by that. And of course, automobiles will be taxed quite significantly. Ang joke nga ng mga analysts ko, hanggang Vios na lang kami. They cannot buy their Land Cruiser anymore because it's going to be 4 million pesos by the time the government's done with all these excise taxes. And you have companies like GT Capital who will be affected by this. And of course, you have the sugary tax, which, maybe we are not recognizing it right now, but for companies like Pepsi and URC, it means that for example, at worst, your C2 now will be 40% more expensive. Like even your 3-in-1 coffee is going to be more expensive. They're not sparing anything. Anything that has sugar will be more expensive. So even companies like Jollibee, they said, because you buy your meals and it comes with a drink, so the cost will be more expensive for them. And they can't pass on the price to the people because the masses who buy the products are very price sensitive. They can't absorb significant price increases at one time. Then you have the end of contractualization. This will mean higher cost for a lot of companies. And again, they cannot just immediately pass on the higher cost right away. So you have companies like food companies like Jollibee, Max, who may have a difficult time, at least in the short term, for the cost. And then cutting ties with the US, well, potentially it could hurt our exporters. Potential tariffs of up to 45%. That's quite a big tariff. And again, tourism from the US. The US is actually number 2 in terms of tourism to the Philippines. And that might have some impact. And the removal of incentives for IT, BPM companies in Manila, because of course people are always complaining about traffic. And one of the things that the Duterte administration is thinking of is to discourage more BPOs from locating in Manila. And this would hit your property companies like Mega World, Ayala Land, Robinson's Land. So they might no longer give PESA incentives to the new buildings who plan to locate in Manila. So that's the short-term bad for those.
Short-term, all right.
Yes, short-term again. To emphasize, it's a short-term negative. But again, the long term will be very good for the Philippines. It's very difficult actually to look beyond the short term, but let me talk about why I am positive for the long term. But at least it's good that a lot of our attendees are already very positive for 2017. So anyway, the reason why the president has to implement all of these policies, especially the increasing excise taxes, which will make everything more expensive, or most things more expensive for us, is he wants the 7% GDP growth to be sustainable up to at least 2040 for the Philippines. Okay, I think one of the criticisms of Philippine economic growth is, we're hitting 7% now, but people are wondering how sustainable is this apart from our consumer spending, di ba? And the government is saying, well, we're going to make this sustainable. And one of the things we're going to do to make this sustainable is we're going to spend more on infrastructure. We're going to spend more on educating people. And again, Joel has mentioned how important it is to have very productive people, well-educated. So that's what the government is going to work at, make the people more productive, better educated, better skilled, which in turn will allow us to attract more foreign direct investments. And the goal is to make growth more inclusive, because the criticism has always been who are benefiting from the growth. It's only the rich, but the poor become poorer. Right now, I think we have poverty incidence of 26%, and I think the government wants to this poverty incidence to drop to 17%. And by 2022, he wants the country to reach high middle income status, or for GDP per capita to reach the $4,000 mark. This is actually where Thailand is already at this point, China, Malaysia, but we're still not yet there. And by 2040, he wants us to reach 12,000 US dollars GDP per capita, which is a high income status. So a very, very exciting outlook. So this is just a snapshot of the tax package, because of course it's very long. So you will see a lot of ways by which the government plans to generate revenues. You look at the gains. They want to generate as much as 600 billion pesos in annual revenues. But I think we should also focus on the potential losses, or what are they going to give back to everybody? First of all, where are they going to spend the money? They're going to spend more on infrastructure, education and training, healthcare, social protection, welfare, and employment. So you see how much they plan to increase spending in all of these, quite a bit. So by 2022, the annual budget for each of them will more than double. So you see where the priorities are going to be. And I'm quite excited here. So focus on the disbursement side. So you see that the disbursements will be growing by 18%, which, might not be excited. Let's go to the next slide. I want you to focus on the capital outlays. So you see the growth on capital outlays will be increasing by 46.5%, or close to 50% next year. And this year was, or 2016 was actually a good year. But if you look at 2016, the growth in government spending capital outlays was around 50%. So we're going to have a repeat of 2016 in 2018 when they get the revenues. So that's very positive for us. Okay, and look at the GDP growth. Okay, for this year, they're targeting 6.5 to 7.5. But next year, notice, starting next year, it's going to be 7 to 8%. So that's 0.5% higher. So every year, we're going to be growing faster.
Yes.
That's what they're expecting, because they're going to be spending more. And I think the important thing to note is our deficit will not be going up. It's going to be kept at 3%, even with the higher spending targets that they want to do. Okay, and again, talking about giving back, I'd like everybody to focus on personal income taxes, okay? So that's where the government will be giving back, at least for this first package, which will be hopefully implemented by July, okay? And I know this is a busy slide, but the point is, you look at the part which we highlighted. There are currently around 5.6 million taxpayers in the Philippines. And with the comprehensive tax reform policy, where the government plans to also reduce the income tax rate, you will notice that 93% of the tax-paying population, 93% of the 5.6 million, will get an automatic 20% increase in disposable income.
Wow,
By, yeah,
20% increase in
20%
disposable income.
by 2018. Okay, so this is going to be a very significant stimulus on consumer spending.
That's
Okay,
right, but I think you have to spend smartly also. Don't drink too much
Yeah.
sugary drinks, don't drive too
hopefully,
much,
no,
or don't smoke.
I think we have to be more aggressive in our marketing and
Right.
encourage them to set
Yes.
aside the 20% to their COL
That's right.
accounts. Ito na yung 20%
yan
to
na.
set aside, di ba? So, but I think some people, di ba sinasabi, paano naman yung mga mayayaman? Mas malaki ang tax. So you'll see here, we did a sensitivity analysis. Less than 1% will be paying more taxes. So only those who, I think, earn more than 700,000 a month. So that's a very high level of salary, no? So everybody else will get a tax cut. So that's going to be very positive for the economy over the long term. So, I mean, it makes me more excited about the Philippine economy and the stock market because of this.
And okay, so I guess my question is because it's a lot of the things I like to do. I like to drive over the weekends, or I want to drink Coke. I mean, how short term is short term, April? Because we're expecting these, these elements to be there for the short term. How long are we talking about here?
Well, kasi the thing is, ano naman the thing, I think, if you look at the stock market, it's a bit weak in general. I mean, ever since all these policies came out, the problem is it's easy to compute the negatives. It's easy because they came out with a policy and said, okay, we're going to implement a 10 peso tax on sugary drinks. We're going to implement a 6 peso tax on gasoline. So of course, like forecasters like me, it's very easy for us to compute it. And of course, a 40% increase in prices of drinks will discourage people. But what about the positive benefits of higher FDIs, higher consumer spending power? How can you measure how much it will contribute to the economy? You have no idea. So I think the long-term positive is difficult to measure at this stage. You will just feel, I mean, for us, for example, how can we measure it? We'll just see a lot of companies, raising their earnings guidance or beating earnings estimates. So those will be the indicators that we look at. It's very difficult, but at least one thing for sure is, for example, if you earn 30,000 peso, you get an extra 60,000 peso maybe, or you get an extra 6,000 peso a month to spend, then you can definitely buy a lot of things. Definitely a C2 that's 40% more expensive is still, not going to cost you 6,000 pesos. So you probably will still drink a little bit of it, right?
All right, so 6,000 pesos for every 30,000 pesos of salary. I think that's well within the minimum for funds, right, Marvin? So, what are your thoughts on this? Are the fund managers also reflecting this cautiousness about the Philippine markets?
You're talking about fund managers?
Fund managers, yes,
Yeah.
correct.
Well, you saw already that the short-term prospects are not as good. And it's easy, April said it's easy to compute the effect on the companies as far as the costs are concerned. And it's very hard to compute the long-term benefits. And I can show you the slides here, what the fund managers are thinking. This is the blue line is the investment exposure of equity fund managers in their equity funds. This is the kind of the strategy of the fund managers that I've surveyed. As you can see, from January 2015, it was 93% invested. In other words, about only 7% in cash. If you're about 93%, you're more or less kind of strong or bullish in terms of your strategy. As you can see, towards nearing the election, the exposure of fund managers have been going down to 88% to a low of 82% on average. In other words, their investment in equity funds have a lot more cash because they're expecting the market to go down, or they don't see good prospects in the equities market. And 6 months after that, they probably a little recovered in terms of exposure. It tells you that fund managers are seeing it like there's an increased risk or increased uncertainty. That is also reflected in the balanced fund. A balanced fund, as you know, is 50% equity, 50% fixed income. If you're above 50%, you're more bullish. You're below 50% in equities, you're bearish. So 67% started in 2015, exposure, all the way down to about 45% before the election. And now it has recovered to about 50-50. So I guess the fund manager is saying that we're neither here nor there. Like a kind of neutral position. With good reason, because uncertainties have increased, as April said, over the short term. I guess they are not yet seeing how is it going to be over the long term.
So if I may just summarize the three very valid points. First, we think that the US is getting better, but that is most certainly going to be positive for us because of improved risk appetite in the US. There are short-term concerns about Duterte, but there are also long-term benefits to be had. I mean, there's a lot of taxes that he plans to impose, but there's also a huge part that he wants to give back to the people. And the fund managers are kind of reflecting this as well. But I guess I just want to change the mood in the room, ladies and gentlemen, that this is actually good news for me as an investor because, it's like a bitter pill that we have to all swallow. It's the uncertainty that is causing these things to happen, meaning not really anything wrong with us fundamentally, but really just the uncertainty of what's going to happen next. So now that we've covered our fundamentals, let's now move on to the technicals. But before that, I'd like to ask you guys another question. Based on your stock portfolio, how heavily invested are you in stocks today? A, is it over 75%? B, 50 to 75%? C, 25 to 50%? And D, less than 25%. Again, no right or wrong answers. We can't tell who answered this or who answered that. So, just to gauge your exposure in today's market. Okay? 30 seconds, I think. We have time for that. So a tax cut, huh? I'm excited about that.
I think all taxpayers should be.
Yes.
The funny thing is we have like, the total workforce in the Philippines is 40 million, but only
Yes.
5.6 million pay taxes.
Ah, wow.
So sorry na lang sa mga hindi nagbabayad ng tax.
All right. So again, if you have any questions to our panel, please, later on, you have the opportunity to use the microphones or text us through 0999-961-1089. So do we have the results? Okay, so it appears that around 42% are over 75% currently invested in the market. So can you comment on that? One is this a sound thing that they did over the past couple of months? How is the market looking technically?
I was hoping that number would be just a little bit less. And you will understand why when I explain that little issue in a while. The reason I really framed that question is because it gives you a good idea of how much has people put in already, or maybe also to ask the question how much people may have to pull out. And the size of how much you've already managed to show over here at least tells you that it may not be 100%, but it shows you that you are taking a much more bullish stand, at least than what April's trying to present to you earlier on. But I hope that I can be able to show you a little bit of more positives with regards to what I'm reading in technicals. Although, yes, we're going to have a very big range. All right. So, yes, we've had 2 new presidents come up in the last year or so, and that means we are going to have to be able to bite the bullet with the changes that they attempt to be able to produce. This can only come with more volatility with our market because as new policies and implementations come around, we will just have to be prepared for it. This morning I was just reading the newspaper, and like April pointed out, I did see in the headlines in the business page it says car taxes to go up by 100%, and all those vehicles of 2.1 million or higher will go up by 300%. So you seem to be in the dot on that. So these are the things that we're going to have to be able to live with through the changes of the new administration. But I believe that going to what Joel told you earlier, the US market seems to be in an A-OK situation. And we'll show you how the trend event of that is, but I'm in line with him too in saying that I am anticipating a correction in the US market, and similarly in Europe. In regards to the concerns about the peso, because I personally have been getting so many calls about people asking me, is the peso going to devalue to 52? Because as we began the year, almost every broker I know were pushing out reports like that. And so the peso is one of the things that we'll talk about, although I noticed in an earlier survey that didn't really matter to you too much, right? But we'll talk about it also. The Philippine Stock Exchange, I think, yes, they'll have a very big range, but I think it is in the road to a gradual improvement. And I'll show you some of the evidences that I've seen to that. And hopefully that the state of where we are in the Philippine Stock Exchange and the Elliott wave is starting already to be able to bottom itself out. But please, bottoming out is a process, and it's not an overnight affair. So just please make sure you understand that. And there will be a lot of trading opportunities this year. Right? So the market's not going to be flat. It's going to be of a wide range. And to traders like myself, I'm going to have a very grand year. And I hope that you follow same suit. With regards to where the Philippines had come from, we started 2017 on a very strong note. Our market just went straight up. And of course, as we were giving ourselves a nice pat on the back, being the leader, if you notice the first graph on your left, please look at the graph on your right, because before that rally took place, we were down a little bit over 17% coming towards the end of 2016. Right? And we were just playing a lot of catch-up movements over here, and that's why, of course, it seemed that we did much, much better than everybody else. But, like in the end, I'd rather have that than have a very flat market. But I think, like I said, a gradual improvement is going to stem out of all of this. All right. So let's start first with the US. But very briefly, you can see very clearly that the US market has done quite well. And I think it will continue to do so. But in the short term, we will go through a correction. We're already hitting the high band of an upward price channel. And if you look at the picture in the bottom of Germany, it's also doing exactly the same thing. And it's very hard to sustain something like this because you've got a huge amount of your crowd making money, and they're just waiting for prices to be able to wobble a little bit, and you will start seeing the profit taking come in due time. So just be a little bit alert that these things may happen, and hiccups from there may cause hiccups from here. So you might want to also make sure that you factor that in. Now, just a little sample in history. I would presume you would know who I'm talking about with a hand. Right? And if you can see the market that came into the Philippines during that particular time, the blue line you see in the middle was election time. And after election time, our Philippine Stock Exchange Index just took off like a rocket ship. And it went back to 8,100 after falling down to 6,084. And after rallying a tremendous amount, after the election period took place, for about 2 to 3 months thereafter, the market just went crazy. And it just went up, and finally it went back to 8,100. Nobody was becoming bearish anymore. Everybody thought the market was going to a new high. Everybody was attacking me and my Elliott wave, left, right, and center. And where are we today? And let's see what's happening in the US. Do you know the hand? I'm not exactly sure if he's telling you how many people attended his inauguration, or maybe he's trying to tell you that the US economy is A-OK, or is he trying to tell you that I'm giving this number of interviews to CNN? Looks like CNN got me. If you look at the period of where the US is, and you can see the same blue line after election, the run-up into their index, we're kind of getting near that period where, just like in the Philippines, a correction was necessary. All right, so I think we're probably going to go to the same thing. They elected him in office. There was an election hurrah. People are saying, wow, all these changes are going to happen. Well, he's here now. The changes are happening. And now the policies are being dished out. And if it doesn't come out as fast as people thought or as wide as people perceived, then that's where some reality checks can come in. And that's probably what's going to sink the correction back inside. Well, of course, not to mention that Joel was telling you we're about 21 times PE, right? All right. So looking into the aspect of the US dollar, as I said, I've gotten a lot of people asking me about this. The US dollar entered into a corrective field for the minute. It was very strong initially because in prospect of interest rates climbing. And yes, mid-December, another rate hike hit us after 1 year of that. And we've been hearing talks that it could probably be a bit more aggressive. I think Joel just said earlier it might not be. It might be surprising. Maybe it might just be a very normal type of recovery. And perhaps I think the dollar is probably sensing the same. And I think that's the reason why your dollar managed to correct. And if you see the graph on the right side, which measures bond yields, it's pretty much doing the same thing, although in the last few days, it did make a little bit of a rebound. But I think what's about to happen here is you're going to see them range. In the long term, Joel says the dollar's going to become stronger, and I agree. And in that particular context, we might be able to see that adjustment later on, but please, it's going to take time. And as this will happen, I don't think it'll affect the peso in a very heavy regard. I'm a little suspicious whether the peso will go to 52 or not this year, perhaps maybe somewhere either in the middle or in the lower end of their forecast. In terms of commodities, looking at gold, gold kind of trades inversely to the dollar. So if you're going to have a continuous strength measure into it, then perhaps gold might have some pressure into it after this rally. So if the dollar is probably just going to go sideways, gold is just rallying, perhaps it's already hit its peak, and now you're just going to see a very choppy movement into the gold market. Furthermore, the inflation threats are not very outstanding as of yet. There might be a little bit, but not that much, so I don't think that it'll produce too much upward pressure into gold. Oil prices seem to be quite sturdy. I guess it is a reflection of the economic demand that has been resuscitated in many of our countries, including China. And despite the dollar actually pulling back a little bit, we didn't really see too much movement in the oil market. But the current trend in the oil market is upwards, and it might continue to test the high sides of that range. I would be a buyer in the oil market if there is a bit of a correction, but this is a long-term hold for the oil market. In terms of the peso dollar, if you would see what we've been going on now, the peso has pretty much moved sideways in the last few weeks, or maybe the last month and a half. And we've been seeing a range of something between 49.24 and about something closer to about 50.14, 50.16. I think it's probably staying to that range unless the dollar does something traumatic, right? So I think we've probably seen majority of the upside for the meantime. But if we get a surprise and we do see a much stronger dollar index, then that's the only thing that will probably cast that on the upside. So I'm probably see a much more gradual devaluation or perhaps just a sideways movement into the dollar. Even the weekly graph that I've seen, I think it may have overreached the movement. You've seen that it's consolidating right now. Both of the MACDs in the daily and weekly are telling me the same thing, that it's gone up a bit too fast and it needs some wind-up time, and that only reinforces the consolidation picture. Going to the Philippines, The Philippine Stock Exchange Index did rally from its 6,500 low, but it has hit resistance. And unfortunately, hitting that wall will create some degree of volatility, and that's why you're experiencing this little difficulty in prices moving forward from where we are. In order for this to continue, there needs to be more gyration or more wind-up process here, because accumulation has to continue, it has to tighten supply, it has to be able to do that to overcome the resistance boundaries that you have. And I guess right now people are waiting and seeing on the side and seeing how much of that they can. Here's the thing. If your answer earlier said that you were positioned by less than 50%, then that would have gone up already, because you would be the one pushing it up. But since you already have 75% of your investment in, that's the reason your market is having a hard time, because you're in and you're waiting for things to happen. Right? So I wonder what surveys can do. And so in this condition that we're waiting for now is, if it can't push up too strongly, or if it does, it might just be a little bit fickle. What are you going to wait for? Right? So we need this market to wind up a little bit more, maybe to provide a little opportunities for prices into a reaction, for it to be able to generate better upside and regain the power to break over that particular boundary. If you look at the picture on the right side, which is a longer-term picture of the index, you will understand what we mean by a very wide range, because you will see the very big picture between 6,000, roughly 6,500 or 6,084 low, and the high zone being about 8,100. And that is a very, very big trading range. In between, I'm sure analysts will cast whatever price targets that they have, but in your perspective, remember, you should be a buyer towards the lower side of that range, and you should be looking to take some profits coming closer to the top end of that range. All right? And we will be moving towards that strategy all throughout our talk today. In regards to the Elliott wave plotted into our index, if you were to see the highlight on the first image on the left, you would see that we're currently in a corrective process, or what we call Elliott's ABC wave. In fact, we are coming to conclude the C wave. Now, that might take some of you a little bit aback. Maybe some of you might say, hey, really? We're coming towards a conclusion of this. And I would be one of those people who would be in that camp, suggesting that you should already get ready, because you don't want to be jumping into a market that's flying off later on because you feel comfortable it will continue to go up. You should be looking at things when things look just a little bit doubtful, but they don't really look that bad, right? And you should start building your positions gradually into that so you can take advantage of the price movements that you've seen. So given the conditions, a lot of people are looking to the Elliott wave conditions of that C wave and asking, how far are we down? And if you can see what I have plotted over there, we may be having a 1, 2, 3, 4, 5 correction on that C wave. And it could possibly be that it's already done, and it's already cast its first swing upwards. But whatever the case may be, you have to understand we're coming to the end of it already. All the big difficult parts are already behind us. There could be maybe a little bit more of a hiccup, but that hiccup will turn itself into opportunity for many of you, and you cannot miss the boat on this one. Just to add some anecdotal evidence, these are the sub-indices in the Philippines. And if you were to look at all that you see there, the first two on top obviously are the strongest. And as you see the strongest ones on top, you will see the conglomerates, properties up there, commercials, and also the financials. These four are clearly where a lot of the money is being thrown in. But even the two not so nice looking ones, which is the mining and the services index, both have already told me signals that they are actually bottoming. So if you're saying that even the worst sector out there is already bottoming, then how far down do you expect the market to go? Right? There's not much meat into a downside. So if you do see a downside, that is the opportunity that you're waiting to finally build that position. That's the first. Second, I know this is a little bit of a lengthy list, but I included that in there for a particular purpose. This is the number of issues in our market that is already within 5% of making a new high, or a fresh 52-week high, rather. And that tells you that the trends of recoveries have come back, and come back strongly. And if you're going to get a big number like this, that is clearly a promoter that there is that positive coming back into your market. So the ones you see that are coloring, that I shaded in green, those are the ones I like a little bit better. And also, if you see all the way to the right side, there are a few red marks on that. That's just simply telling you that that particular company is overbought right now. So that means you might just have to wait for pullbacks before you guys attempt to be able to move into that. Even the not so good companies are starting to recover. And that also is where I'm saying that it kind of produces a floor to it. And so many of the laggards that you see into a market have come around. There are quite phenomenal amount of names into that list that many of you can actually choose from. An example of one of those two companies that you have inside are shown there, right? So I think the one on top is ICT and the one below is BPI. Yes. And if you can see the images, it tells you already that the maximum selling string has come. There's now a period of wind-up that's being generated. It may not be finished yet, but in the case of ICT, it's already started to move. And we do have quite a number of these issues showing similar particular types of patterns. So take advantage of pullbacks, making higher lows, because these can be your entry spots. Now, I put the Philippine Stock Exchange Index on top and the All-Share Index in the bottom. Both of them are telling you that, yes, although we have a little bit of a sideways range and a wide range at that, the general bias over here is still turning upwards, right? So if you see this market dip and you get a retest of the recent low, or God forbid it goes slightly lower than that, it still produces that entry spot that many of you perhaps were waiting for but did not get. So if you see it come around to be able to pick that up right now, this is your opportunity. Because this market is only going to remain in consolidation for so long. And I don't think you want to be buying this only in the beginning on the upper boundary, but rather near the lower end. So looking into that, let's just have a look at your argument. So it says that your sub-indices are already starting to be able to show periods of accumulation. And I think this is a very important point to make. Second, you can also attempt to be able to look that a number of leaders are already hitting 52-week highs, and of course this is very helpful because it starts showing you uptrends once again. Even the laggards are starting to be able to base out. That will also limit the potential downsides of your market. The Philippine Stock Exchange itself has actually made a higher low, at least so far, and that contributes to an eventual turning of this particular consolidation. And of course, if you can see the movements that you have in terms of the all shares and the other factors that we looked at, they're all telling you that supportive levels are coming back on the lower end. So I really don't see why you'll be looking for more reasons to be able to potentially pick this up. Okay, so the only adjustment we're going to make in the short term, because I think so far everybody here in the short term is a little worried about corrections, and so am I. And given those conditions, so we're not going to be chasing markets right now. It's still going to take time for markets to be able to pull out of this big wide range. But every time you see these reactions come in and you see support manage to hold, then you'll be buying your reactions, you'll be looking for breakouts, you'll be looking at typical trading maneuvers that we've taught to many of you guys who've attended our seminars for quite some time. And all these things will be kicking in this year, and you can really leverage your use of technical analysis. So try to be able to look more into that. So typically you're going to be looking at patterns like this, and your entries should be in where those green circles are being pointed to. Don't be buying on the high range, be buying on the lower ranges. Okay, so when you see the green circle in the lower end of the trading bands, this is where you guys should be looking at. Or if you see major breaks coming off, very long patterns, so these are also worthy breakouts to be able to pick up as well. Okay, so in summary, overall markets still show pretty much good solid advances, although yes, there is an overbought condition that may warrant some short-term pullbacks. The PSEI pretty much in the same, but it has a very wide trading range, and that will give you the advantage to be able to have some trading space. It will not be tight. This will be quite wide. And hopefully, if we can just manage to break over that 7.4 or 7.493 zone, then the next upsides will likely be closer to the 7.7 and 8.1. But that 7.493 area is very critical. And so I hope that we can break that into the short term so we can have a little bit more upside, at least many for you. Because if we don't get it now, we're probably going to talk about that in the next market briefing, which will be in mid-year. So 6,500, I believe, is a strong support for the market already. If you see your market head back in there, I think your confidence should pick up. Your confidence should not go down, because now that the market's finally giving you that opportunity, you should sit back. The anecdotal evidences are all in place for accumulation, and this is quite a positive flow. The peso, yes, they might devalue, but I think it'll be very graduated in its approach, so that shouldn't scare too many people. And of course, we should keep the ability for trading activity to be quite apparent for us and open, so that at least many of you traders out there will have much windows to be able to position yourself for this year. Right? Maybe I just want to be able to leave you with that big statement so that you can try to be able to weather the storm, so to speak. But that statement also says, as the market comes closer to the period where a lot of people don't know what's going on, you shouldn't be getting too scared, but using that as an opportunity to buy companies at these reduced valuations, right? And technically, you'll be buying closer to support, and that should be quite helpful for them. All right, thank you, and Happy New Year to, of course, the rest of you.
Thank you very much, Juanes. So if there is just one hashtag I can think of, is hashtag what more do you want? Can all post that. And now, moving on to our pooled fund segment, let us again ask you guys another question. All right. Which type of mutual fund do you think performed the best in the past 5 years? Is it A, a bond fund, B, a balanced fund, C, equity fund, and D, the equity index fund? Of course, the results here are going to reveal whether you guys know about the FundSource website or the research capabilities of our website. Again, if you have any questions that you like us to answer, please do so through SMS at 0999-961-1089 or through the microphones, which we will turn on a little bit later. Interesting to note what the answer is, huh? Okay, do we have the results? Okay, so interesting answer. The top answer is 52% C, equity fund. Well, theoretically, yes, it should outperform everyone. But, Marvin, can you care to
Yeah, it's
explain a
interesting.
bit?
Huh? 52% equity fund. These are your managed funds. Your equity index fund is 27%. Let me just show you the actual results. Yeah, I think the result is different from what you think.
Yes, because if an index fund is supposed to be passively managed, right? It has lower fees with the fund manager just rebalancing according to the index. But an actively managed fund is designed to outperform the index.
Yeah, it's interesting to find out because the sentiment right now, or the investors are it's changing. And I will show you later the reasons why. As you can see, the 3 years and the 5-year compounded annual growth rate, the equity index funds are outperforming. The bond funds and the balance funds are lower because it's a mixture of fixed income. And fixed income returns are lower, but less volatile. It's understandable. But on the equity fund, the equity managed funds, the actively managed, is underperforming the index. What is he trying to say? Equity funds' purpose is to outperform. That's what the fund managers want to do. They want to outperform the index. But in the process of doing that, they try to trade, time the market, have a little bit more cash because of these concerns, this volatility, and they do value, they do small cap, big caps. So there are certain things that they do, and it's very hard to sustain on a consistent basis. Sometimes they might outperform 1 year, but they do underperform the next year. That is why over a long period of time, you can see the index outperforming. And the reason for that is that the equity index funds move because of flows. There's more inflow in the fund, they buy. They don't talk about valuations or anything like that or strategy. And as you know, the market is still 50% foreigner. The sizable foreign presence is still here. About 50% of our trades are coming from the foreign. And if I would give you more information on foreign, they're also changing. Their strategies are also changing. So much so that the flows on the Philippine market also is affected by these flows. As you can see, the red line is the net foreign inflows, and the blue line is the stock market. There is a very strong correlation that when the flows are coming in, the stock market's going up, and the others, when the flow is out, the stock market goes down. So you can see there's some level of consistency between the two. And I would like to add some more information here, since the Philippines continue to be one of the smallest market in the world. If you are you're a foreigner, you're managing a fund in Asia, ex-Japan, only 1.4% of portfolio is in the Philippines. And if you only have 1.4% in your portfolio, it don't really matter that much. When you make a decision, when the flow comes in, you don't really think so much of the valuation of that country. You just have to sell. Or in inflow, you have to buy. You have outflow, you have to sell. So that's why there's a large movement on our index or on the market because of these foreign flows that don't really care about how the valuations are. They just care on the flows. And likely so, because this is a chart that's very interesting, since, as you can see, this is a net inflow to US stock mutual funds and exchange-traded funds. This is the flow that is going to the funds. And for the past 10 years, the US, particularly, the flows are going to the passive funds. The black bars are your passive funds, or the index funds, for the past 10 years. And the active funds are getting a lot of outflows. What does that mean? They're just putting their money, the Americans are smarter, they're putting their money on the passive funds because the fees are lower and they perform better. And that is the thing that's happening in the United States. So much so that the performance as well tell you why they're moving to the passive funds. Majority of the active funds underperform over a long period of time. In fact, for the past 5 years, only 14% of all the mutual funds in the United States outperform the index. And it is, for 1 year, 30%, for 3 years, 24%, and 5 years. So over a longer period of time, they underperform. And
The fees are still.
let me put that in the Philippines as well. Only 11% of actively managed funds outperform. That's about 2 out of 18 equity funds. Just 2. So we see that as well now starting. The one you saw in the US past 10 years in terms of the flows, this is the chart of the net inflow of local equity funds. And you can see in 2016, that is starting to move. The red one is the actively managed funds. So you saw some outflow, and the blue bar is your index funds. So the flow is now moving to the index fund for the first time in 2016. Then even if the assets under management of all the funds, the UITF and the mutual funds, went down from 169 billion to about 155 billion, or an 8% drop, the index funds experience an inflow. So the behavior of investors now are kind of moving towards this. And I think it is very critical for us to understand how markets are moving now. It's not just in the US, it's also happening here. It's critical for you to have a more efficient portfolio is to have an index fund in your portfolio as some kind of a way for you to participate in this flow and in this market. The actively managed funds are good sometimes in 1 year or 2 years, but over a long period of time, they underperform. You can have an opportunity for that, but sometimes you really have to mix it in order for you to kind of ride this market?
Just, living half in the Philippines and living half in the United States, and my mom also being Filipina, and my fiance too. I don't see why, I don't see why it'd be any different in the Philippines than it was and has been in the United States. What they found really globally, but what the US has seen is that the cost of having an active manager and the higher fees are rarely offset by the manager's skill. And so when you have the high fees of having a manager actively manage a fund, and you have the skill less than as good as the fees, well then of course the active management funds underperform. I don't see why that would be any different in the Philippines over the next 10 years. Not in all fund cases, but the fact that I think is 1 out of 7 US funds might actually beat their index. I don't see why that would be any different here, because the fees really steal a lot over time. That extra 1 or 2, or I've seen even 3% in the Philippines, over time really steals from your performance in a way that the active manager really can't beat. It's very, very, very difficult.
That's why we saw the flows are going now for the first time, 2016, towards these index funds.
I think that trend will have to continue, right? Because I think Filipinos are seeing the same thing that the Americans have seen.
All right. So I guess the main takeaway there is why sweat it with an actively managed fund, right? You just go with an index fund with low fees, which has the most likely ability to outperform the market, right? So there you have it. That's our economic and financial market outlook in all these perspectives. Now let's go on to what you came here for, our specific fundamental, technical, and fund picks. But before we get into that, let me again ask you guys another question. Enjoy ba? Anong game show lang, ano? Okay, what do you think is the most important theme in picking stocks that will outperform this 2017? Is it A, value, B, growth in earnings, C, the industry or the sector it's in, D, small caps, or E, blue chips? Again, no right or wrong answers. It all depend on what you think is the best theme in picking the stocks that will outperform in 2017. Do we have a result? All right, so 44% says that it is growth in their earnings. So pretty fundamental in that regard, right, April? So it's also 25% based on industry, and 15% of you think that it has to be off value or cheap in order to outperform in 2017. What do you think, April?
Yeah, I have a very complicated answer to a simple question. Yeah, but I'll start out by saying I have a bias for value.
Right.
Because I just want to highlight again, in the short term, we have so much risk. One of the things that, one of the reasons why fund managers are cautious at this point is, the risk of higher inflation this year. We have the weaker peso, you have rising commodity prices, more excise taxes, and again, potentially richer consumers who will buy more goods. So higher inflation means higher interest rates, which is not good for the market. And the weakness of the peso is not 100% due to the US dollar. It's because of our shrinking current account surplus. The point is, Filipinos are becoming richer. And aside from that, our investments are picking up. So it just means we're just buying more imported goods, right? Like when was the last time you bought something from Bench? Probably you were going to Uniqlo, H&M, or whatever, right? So, that's just an anecdotal evidence that, that's why we now have a weaker peso, because we're just buying more imported products. And, a weaker peso is not good for 50% of the investors in the Philippines, which are foreigners, because when they translate it back to US dollars, they're actually ending up losing money, right? And again, the short-term policies of Duterte. And finally, we guys talked about the importance of earnings growth. Unfortunately, this year, EPS growth of the PACI is only 7%. So in light of that, given all of these risk factors that are present in the short term, it's difficult to justify expensive valuations. Or again, I feel like there will be an opportunity to buy cheap. So, I mean, the 7% rally of the market for the year-to-date people is making people excited. But nevertheless, I think, let's think objectively, there will be opportunities to buy value at this point. Okay, but again, I guess, diba, one of the things we talked about is how do we actually pick stocks, no? So medyo na-nervous nga ako dun sa tanong mong yun. Kasi, diba, we've had this product, Calling the Shots, for the past 5 years. And, well, how have we performed actually? And I'm proud to say that we actually have performed quite well. We did an equal weighted index, assuming that you bought all of the stocks that we recommended equally weighted, and we balance it every time we come out with a new report. And our hypothetical fund actually generated a return of 23% per annum, compounded, versus the index, which is, I think, 9%, no? Nice. So total holding period return is 170. Sorry, hindi ko na talaga mabasa. Versus
178.5%.
Versus 51% for the index. No? So we actually performed quite well during the past 5 years. Okay. So in that respect, we actually outperformed the fund managers. So
that's right.
Yeah, so
April.
So process of picking stocks.
April, are you considering opening your own active fund now?
No. No, the pressure is too much. Pag marami ng pera, mahirap na. But anyway, this is the process of picking stocks. And I think this is what they teach you in school. No, you pick a good industry. It's a top-down approach. Pick a good industry. Look for fast growing companies in the industry that has good prospects. And finally, those that are trading at cheap valuations. Easier said than done. When the market becomes mature, they become, or let's say, especially when the bull market matures, the markets become more efficient. Kasi dumadami na yung tumitingin eh. So immediately, it will be very difficult to find these stocks that belong to the good industries, have rapid earnings growth, and are trading at cheap valuations. Usually they are expensive. So what we try to do now is we combine a top-down, bottom-up process. So we try to identify changes in the top-down, or in terms of industry, probably regulations. And then, you know, we look at bottom-up. We try to see, I guess we try to answer some questions. What's priced in the stock? Is this stock, I mean, what's important is, I think you will see me talking about, when you read our reports, you will see me talking about why do I still like the stock even if it's been sold down. Then I'll say, well, I think the bad news is priced in, or I think, you know, people are just too bullish, let's just sell this stock. So it's very important to know what's priced in the stock. I think Joel will agree to that. That's the most important way to outperform the market. And do I know something that the market doesn't? Do you actually have an advantage? You have to be honest about this. If it really is that way. A lot of hard work. The fact that we have actually around 7 to 8 analysts who go out there on a consistent basis, on a quarterly basis, helps because, for example, the foreign brokers would only have, say, 3 or 4 analysts, and they don't cover the smaller cap stocks that we do. They don't have as much time going around. And is there a catalyst in the near term? I admit I'm a bit weak on that. No, sometimes I pick stocks that don't have near-term catalysts, but this is something that, you know, sometimes if I get really excited about the stock, it's because I know there's a catalyst in the near term. But some of them, even if they don't have a catalyst, my feeling is earnings will justify the valuations because fund managers will finally recognize that they are wrong when earnings finally come out. So I'll talk about some of my best picks, like DNL. We bought this in February 2013. We sold this in 2015, so more than 200% up. And the reason why we were able to identify this stock was because when I was a young analyst in the 1990s, I was covering ChemRes, which is one of the sister companies of DNL. And I knew the family. They're very, so I knew that the family was very good. They're very technically competent. And of course, when they listed, we visited them immediately. The fund managers didn't understand their business because they had a complicated business that they listed, and it was 50% commodities. So people were so focused on the commodities, they didn't want to buy this stock. And the market cap was below the, I think foreign fund managers want 20 billion peso before they even start looking at it. So this one had a market cap below 20 billion peso at the time. So I understood the business model, that they weren't just into commodities, they were actually shifting out of 100% commodities into specialized products, which, made their customers sticky, and increasing margins would allow profits to go up. So they were more of a consumer company, and they were trading at very cheap valuations, which is why I recommended this stock at that point in time. And now, right now, the thing is everybody knows what it's doing, and everybody loves this stock, which is why it's not going down anymore. But then again, at least we were able to make that much money in 2 years, which I believe is a good thing. Again, unfortunately, there was no catalyst, so you can see after we bought it, it still went down a little bit before it went up. But at least we were able to make a lot of money from that. CNPF, this is another stock that we recommended last year, and it made 64% for us in around 10 months. The thing is, the company disclosed that they bought the coconut business. So this is the maker of Century Tuna, and they are a toll manufacturer of Vita Coco. The thing is, what's good with CNPF at the time was that there was not much analyst coverage, and the analysts didn't have time to upgrade the forecast to reflect the acquisition. So we were able to do it faster than everybody else. Recommended the stock, and because of that, we were able to recommend this stock, and it allowed our portfolio to outperform in 2016. Okay, so our stock picks for this year, still, the existing stock picks, FGen, Metrobank. So first gen, we'll start off talking about the reasons why they were weak, and then why we still like them. So FGen was sold off because of falling coal prices, and they have a new plant, and there are concerns that they will not be able to get contracts. Why we still like them? Well, because coal prices are now recovering, and the new plant that people are concerned about is actually now operational. So there's a better chance that they will be able to lock in a contract with a higher coal price, and with the plant already being complete. So the next stock is Metrobank. Again, this has been there quite a bit, but I think one of the reasons why it didn't perform well last year was because it had weak earnings growth. So again, the concern about earnings growth is valid, but and the provisions are up, so people were thinking that this bank had bad debt problems. So again, why do we still like it? We did a lot of analysis, and the earnings, the reason why they drop is because of the provisions. But the provisions are not because of higher non-performing loans, but because in 2015, they actually did not provide a lot. In 2016, they were just normalizing provisions. And on the net interest income, what they did was they shifted out of trading or of bonds and into loans. Loan growth is 26%. Now, if you look at the bank, what is more important is that they grow their lending rather than their trading business. Because trading is something that you don't know if it's sustainable, but lending is something that is. And aside from that, I think more importantly is you see the insiders now actually starting to come in and buying the stock. So it just means that there really is no problem with the company. So, I think that's a very good indicator that this is a solid stock, and if you haven't looked at it, now is a very good time to actually start looking at it. Okay, other stock picks, so Mega World. Reason why it was sold off, its residential take-up was actually going down, and right now there's a talk of a possible oversupply in the office segment. Okay, and Duterte's more focus on decentralizing growth will, of course, affect the office segment. But why do we still like Mega World, given all the bad things, we believe that the negatives are priced in. This stock is actually trading at a 50% discount to the fair value. 50% discount to its net asset value. Meaning, if we add all the value of its land bank, building, malls, it's trading at a 50% discount. So I believe that the negatives are priced in. So again, long-term prospects remain positive. But again, you might say, well, there's no catalyst. So this is more of a long-term stock if you buy this. This is not a stock that might outperform right away. Next, we have, the next few ones are new. We have RHI. Okay. This stock was sold down in the past because of concerns of intensifying competition in the retail segment. I think 2 to 3 years ago, margins of retailers like Pure Gold, RHI, SM were being eaten away because they were locating near each other. Okay, so they're competing intensively. But now competition has rationalized, and yet the share prices have not yet recovered to reflect the improvement in the competitive environment. So we think there's an opportunity for stocks like RHI. So next, MCP. I think you guys might be surprised that we're recommending such a stock. The thing is, talking about why this stock was sold down, remember a few years back, casino stocks were the most exciting stocks to own, and they were just going up because, of course, because of the illusion of how much they can earn and everything like that. It was a great story. But unfortunately, when it really did open, it disappointed everybody in 2015. And of course, there was this crackdown on Chinese gamblers. So profits disappointed, and people were worried that the VIP players would not come in to the country. But why do we like it? If you actually go through our research reports, the casino stocks have been outperforming the past 3 quarters already. They're one of the best performing sectors in terms of profitability. Macau numbers are already rebounding. And aside from that, the infrastructure development, I think the NAIA Expressway, the toll roads going there will allow greater accessibility to the City of Dreams. And I think the best part is, since analysts medyo nasunog din dyan kasi naging sobrang bullish in 2015. Now they're very conservative in the forecast. But based on what we see, we feel like MCP, Bloomberry, and Resorts World will all outperform the estimates that are available right now. So that's why we like it. And finally, we have Semirara. Falling coal prices. Reason why it was sold off, you have falling coal prices. So concerns of possible suspension of the mining operations because of the stricter DENR. But now we have rising coal prices, and the mines weren't suspended even after the audit. And you also have insider buying for this stock. So that's another good sign. No? Okay. And then the last one is Meralco. We are recommending this stock. The stock was sold down because of there was news that came out that they will not be allowed to participate in the retail electricity spot market. And they were also negatively affected by the rebalancing of the FTSE. Actually, that's one of the things we love to look at, mga rebalancing. Kasi pag may mga stocks na binibentahan because they get removed from the index, they get removed from the MSCI, that's actually a great trading opportunity for investors to buy. No? And Meralco is no exception. Wait, masyadong advanced. Sandali lang. So, why do we still like it? There are talks that they will be able to participate in the retail electricity spot market through a subsidiary. And of course, the rebalancing of the FTSE is already complete. And finally, there's also insider buying for this stock. For those of you who are hanging on to your PLDT because of cash dividends. So anyway.
PLDT kasi.
Kinabahan ka ba?
PLDT.
So anyway, for those of you who are hanging on to your PLDT for your cash dividends, you may consider switching to Meralco because Meralco gives a 5% cash dividend. And more defensive compared to PLDT. PLDT maraming problema ngayon. So you may want to switch. And potentially, the dividend could be as much as 9%. But for sure, 5% is in the bag. Potentially up to 9%. Right. Mm-hmm. So, yun. And then we're removing Ayala Land, RLC. So these two stocks have actually rallied recently. We talked about the risks a while ago on the properties. And possibly the government not giving any more PEZA accreditations for buildings in Metro Manila, for office buildings. So that's really not going to be good for property companies. Hindi naman ganun kamura yung Ayala Land at RLC. Nagrally na sila. So that would be your opportunity to take profits. DNL, again, fundamentally we like it, but it's just so expensive, 28 times PE. It's higher than our fair value estimates. I mean, we still like it, but we feel like it just might underperform in the meantime. If you want to keep it, just keep it, but no point in buying more at this stage. And, sandali. So, ito yung summary para hindi dami-daming titignan.
We will provide everyone with a soft copy of the slides that you saw this morning.
And then, teka, I think may, some caveats lang. Baka naman, nagkakamali rin kami ha. Yun ang gusto sabihin. Not all of our picks make money. 30% of our stock picks based on our analysis actually lost money. So, syempre pag, di ba, there's a negative news that we did not anticipate. Hindi kami umaasa. Cut loss na yan. And then past performance is not an indicator of future results. And in light of the mistakes that we do, of course, I just want to say diversification is important. You can see the odds are in our favor, but of course, you have to have a diversified portfolio. You can't just buy one. And investing in stocks is a long-term endeavor. In the short term, we may lose money, be volatile, but we're, if you hang on there for quite a bit, then we're quite confident that you'll make money with our picks.
All right, thank you. So, Joel, are you looking at particular stocks here in the Philippines? Of course, in relation to what you observed in the U.S. markets.
My comment is more about the stock picking style that they use. Okay. That concept of the three. I'm not surprised about the performance because when you hear from some of our clients, some great investors in the States and globally, that point of, number one, make sure you know what the market's pricing in. Number two, is there something you know that the market doesn't? And then three, if you have the ability, right, getting to a catalyst, are really the three steps that you find any great investment manager. So I'm not surprised that your stock picks have done very well. It's very consistent with great money managers around the world.
Right. Okay, so I have so many questions, but in the interest of time, I'll ask them in the right opportunity later on. So now let's move on to the technical picks. Again, I'd like to ask everyone another question. Given the ongoing run-up, which set of stocks do you favor? A, the leaders, those that have already started to rally, or B, laggards, those who have yet to rally. So Juanes, can you clarify a bit on what leaders are and what the laggards are? Aside from what's mentioned over there.
All right. Well, a leader is a company that is outperforming in terms of its run-up. That in general, perhaps maybe many of them have recovered a significant amount of the pullbacks they've done, whereas a laggard is the one that's still taking some time to be able to make a recovery. It could be for various reasons, whether maybe like it says, maybe the growth is not there, or maybe it's too expensive, or but the general movement is still very, very slow.
Okay.
Right? But the conditions are, leaders are those ones have already outperformed the conditions of the market, and we can talk about some detail of that after the
All right.
result.
So, do we have the results? Results, please. Ooh, 62.5% says that it is the laggards. And 37.5% says it's the leaders. So again, no right or wrong answers here, but can you comment on this, Juanes?
Well, being a technician, timing is everything for me. And usually waiting for a stock to move is perhaps one of the last things I even wait to do. I'm usually at companies that are moving already today or moving even faster, because these are the ones that can give you much more short-term output in terms of waiting for a potential reversal in the other one. So I'll talk about what your results mean in a little bit, but let's try to identify. So you're looking into a leader. These are the guys who's conditioning the forefront of activity. They tell you they're all right already, they're becoming very popular, volume is heading in their direction, they're able to have pliable space in terms of their upward movement. Some of them have already gone to their 52-week highs, maybe even over. And there really isn't much question whether this is a popular issue anymore or not. And the only difficulty you may be having is, has it reached its valuation levels, or is it getting ready to correct, right? And you might think, maybe you might also doubt whether there is the ability for it to move forward from there might be big or not so big. But you have to understand that there was a point maybe 2 years ago, if you were to look at the price of DNL, that at that time, you might have considered it a leader, and you might be saying, wow, that looks too pricey for me. And today, as she pointed out to you, it showed a return of 200+%. Only so far as because the business was doing well, and it did so not just for that 1 year, it did so continuously, and that kept earnings growth quite healthy. So the argument of buying leaders is really positioning yourself into companies that are not really that doubtful anymore. They've shown you what they're producing. You're quite comfortable with them. They're climbing because the results of their fundamentals are very clear, and there's popular support for the stock, right? So I think leaders are really very, very quick to be able to respond to your need, that if you want to have these results relatively soon, then you might want to be able to have a look at that. For example, look at these two companies. These are an example of leadership, right? I think the first one on top is Bloomberry. The second one underneath is Costco. And if you see the stock, it went sideways for a very, very long time, and then it shot up. But prior to that, it had bottomed out. But look what happened. After bottoming out, then it created a very, very long and wide pattern before it actually shot up in recent days. And so that's what happened to a laggard, because you have to go through that period of accumulation. Whereas these guys are already storming up, and they're producing gains already for people who are trading them. As against laggards. And for example, look at these two. So you've seen a significant amount of a decline from them, and they seem to be bottoming out, and point in fact in the word seem, because what that means right now is you're only thinking that it might do what you're thinking it's doing, and it's only now that some popular support is coming into it. That's why it seems to be basing up. And whether it does go up in any short period of time is really very questionable. Okay, so the laggards take time to be able to jet set up into that activity level that you want. Now, can you make money in both? The answer is yes. And your answer earlier in the survey tells me that perhaps the type of investor you are is the one who waits too long. Right? Because you're going to say, whoops, he moved, and I haven't bought anything yet, so dito na lang ako. And I'm telling you, you can make money there, but you're going to have to be patient, and you cannot be the type of investor that would say that when you would buy that, and you see another issue move, you might say, oh, sige, doon na lang ako. And you'd sell this and move there. But then this starts to move, and you said, oh, now it's moving. And then you sell this and move back to the other one. I mean, it's tough playing a laggard, right? Because mentally, you have to be prepared to be able to storm it. Remember, the fundamental value is there. It's recovering, but it needs time to be able to produce that sort of effect. So just be a bit more patient. Whereas laggards tend to be much more shorter term. They can very much fulfill what you're looking for right away. And you just buy pullbacks into the leaders whenever you have that opportunity. Now, one question I will maybe ask you back is, if you have a leader versus a laggard, and they are both correcting at the same time, which would you buy, the first or the second? The first. So in the end, even that condition, you're going to be buying the favorite one. Amongst all the laggards that you see, if you have 20 laggard stocks, which one of all those laggards will you buy? The weakest performing or the strongest performing laggard? So even in a laggard, you're looking for a leader. So I rest my case. So I wonder if you can identify the following statements in April stock picks. So can you please tell me whether, sorry, let's start with the first one. Okay. So let's start with the one on the left, which is Metro Bank. Based on the picture, leader or laggard? The one on the next one. All right, so you can identify. You can see how clear the movements are, and that they're telling already the period of wind-up is finished, and that a much more intensive movement to be able to drive the stock up is very much picking up. All right, let's look at Mega World and the next one. Yeah, Robinson's Retail. Leader or laggard? Both of them. They look almost the same. Do they look like Bloomberry's chart? Do they look like MCP? So you see this still in a phase of accumulation. So you can see it's turned down, it's trying to bottom out, and it's now preparing their wind-up patterns. Don't get me wrong, these guys are eventually going to climb well. But the question is, in how long? Right? But they are. I think these two companies have already bottomed out. So for you guys who are interested, this might be a good level to start building your positions in. But like I said, be patient. Why is that so funny? People don't want to wait here.
Madaming nakaka-relate yata doon, Juanes.
And Meralco and FGen, I mean, both pretty much in similar power-related industries. You can see that the first one have already picked up. It's just that Meralco's hit an area of resistance, and it needs some wind-up from here as well. Whereas FGen is taking a little longer time. You know, many of the fund managers that I talked to, although I know April has suggested this to us before, they seem very hesitant because in terms of which one moves first, FGen tends to be exactly what the name said, a laggard. All right? Now, will it climb? I think it's just a matter of time. It will. It's bottomed out, or Meralco is much more clear in that sense. So my tendency is to stay with the more formidable one first, and I will only switch to the other one if I really have no other choice. And with the last one, Semirara, I think you can clearly see the trend here is very solidly upwards. So how do you attempt to trade issues like this? So you can see the clear channel that's been produced. It makes corrections closer to that lower end of the band, and that should be the objective you have to be able to buy the company on those support areas, as long as, of course, the stock does not overreach April's fair value. So those are the merits of how you would probably marry the fundamental and the technical conditions. So every time you see it overbought, you see things quite striking, then you back off first, you take a little profit, and you wait for prices to calm down and head into these areas. And that's how I would trade these issues.
Thank you very much, Juanes. Now let's move on to our fund picks. But before that, Let me again ask you another question. So, can we please flash it? Do you feel that you are spending enough time managing your portfolio? A, yes, or B, a no. Okay? Are you spending enough time managing your portfolio? Again, if you have any questions later on for our question and answer portion, please feel free to text at 0998-961-1089 or use our microphones, which we will activate later on. Let's see the results. 62.7% of all our customers here and a good random sample of our equity investors feel that they do not spend enough time managing their portfolio. What do you think, Marvin?
Yeah, understandable, no? Because the market is really very volatile, and listening to April, to Juanes, you have to really have enough time to understand what they're saying and to put everything together, time it, right? That is why I'd like to remind our premium customers that, the last time I spoke about this, there's a smart way of doing these things. And I'd just like to remind you the ones I presented earlier. The word smart in terms of managing your portfolio. S simply means that to stay invested. You just don't know exactly the right time to do it, but we will know short term will be volatile, but long term is going to be good. The next 10 years, I've said in the briefing that I will not be surprised that the market can go 18,000 by 2025. And maybe we'll be moving on a sideways for this year, but towards the next 10 years, anyway, your stock is really for long term. Stay invested as the first strategy. And however, on the way there, it's not going to be a straight line. That is why on letter M, when you manage your portfolio, manage the risk by diversifying it. April said that pick the stocks, diversify your portfolio. The next is asset allocation. Critical, it is not the stock pick or the security pick that is more important. What is more important is the amount of money that you put there. Is the allocation that you put there. So that is where the return really comes from. And the next is regular investing. We all work and we will generate cash over a long period of time as long as you're working. The age bracket here is in the wealth builder, the ones that continue to earn.
Yes.
And regular investing will help you a lot by putting some money over regular on a monthly basis and on times that there's opportunity. And of course, the last one is to review your targets, review your allocation every so often. Maybe every time you attend our briefing, which is about twice a year, to review your portfolio where you are. If it's still within your risk appetite, it's still within your level of comfort, and it's the one designed to reach your goals or reach your financial independence. And but let me just focus on the asset allocation for today. What is clear is that we have 3 stages in our investing journey, and I presented this before. The blue portion is the equity portion. If you're 35 years, somewhere there, 80% is a good allocation for you. And the survey earlier said that you're about the 36 to 65, the wealth builders. That should be a good asset allocation. But this is just a kind of an ideal allocation. It really depends on you. Sometimes they use your age for your kunyari, you're 40 years old, 40% in fixed income and 60% in equities. That's a good indicator. And then the next slide, how should you do your equities portfolio? Since we are centering on equities because that's the best performing stock, best performing asset class. Equities, I suggest consider index fund. I showed you earlier how the investors are moving now. It is very hard to outperform the index, and it's better and more efficient for you to include index funds in your portfolio so that you can grow and ride this market. You don't have to time it anymore. Plus, put a tactical exposure. You have time to look at the the calling the shots, the technical analysis, put some of these stocks to mix, to put a little bit of excitement in what you're doing. Because index stocks is kind of a little boring, but you know, it gives you the return. Then put a little bit of this tactical exposure, which basically adds a little bit more fun in investing. You can time all of this investing. And on your fixed income, I just suggest for those who have invested in fixed income, put it to the short-term money market funds and some short-term bond funds. That is just because interest rates are moving up. I suggest you just shorten your exposures there and then ride this market while interest rates are moving up. And then for your equity position, I will categorize it to a strategic allocation and a tactical allocation. Your strategic allocation is your long-term. That thing is that keep it for the next 5 to 10 years. That is your ideally equity index fund so that you can participate a bigger amount. Because if you put everything in stocks and you put or 4 stocks, you cannot really put a lot of money in those stocks. But in index funds, you're diversified. And you can capture the flows of the overall market. Your tactical allocation, that is where you can participate in the inefficiencies of the market. I said earlier that the index funds are being affected by flows, by the foreign flows. Sometimes it exaggerates because they don't really care of the valuation. If they have an inflow, they will buy. So there's an exaggeration sometimes on the index. That's why the index stock sometimes becomes more expensive. But the laggards, or the ones that are non-index, there's an opportunity for you. So you add your tactical allocation to mix. Sometimes when they sell down the index too much naman, and then the laggards, or the non-index ones, there is an opportunity. So it's good for you to mix your equity position. So the COL has available in the COL fund source in your accounts. You can activate that. You can buy any of these index funds. And the ones, the top 2, the Philippine Stock Index funds, the Phil Equity PSE Index funds, they performed well for the past 5 years. The 2, PAMI and Sun Life, has just been launched in 2015. They don't have a longer track record. So these are the things that you can consider and put in your portfolio. So asset allocation is very important. Remember, just review it and then look at where you are so that you can participate in this market in a more meaningful way, in a risk-diversified way, so that you can sleep and you can join and participate in the growth of the country.
Thank you very much, Marvin, and thank you very much to all our distinguished panelists this morning. And before we move into our question and answer portion, let us view the results of the first survey we asked. And that survey was, there you go. So 34.8% of our customers are weak bulls. At 7,700 to 8,100. While a good 30% are neutral at 7.3 to 7.7. But the more exciting bit is we will again take this survey one more time. So see if there are changes. So again, we give you 30 seconds to input your answer after hearing what our panelists have to say. What do you think will be the PSEI? What will it be at the end of the year? Is it a strong bull? Are you a weak bull? Are you neutral, a weak bear, or a strong bear? Please key in your answers. Again, if you have any questions in the question and answer portion, please feel free to send it through SMS through 0999-961-1089 or use our microphones later on for that actual question direct to our panel.